Kevin, what's your take on these infrastructure stocks and the framework that we're seeing right now?
A really interesting time here because you're not guaranteed the bill. Everybody knows there's still some risks. There's lots of political shenanigans that have to go on to get this thing done. So you don't see the full premium yet. You can buy Honeywell or any of the infrastructure plays and know that there's probably another 10 to 15% left on the upside here if this actually gets passed, because you've always got the risk premium built in. It's not done yet. But I really like the setup for the back end of this year on equities. I mean, all of this stimulus, whether it's this package or one that's even bigger, a Fed that's benign, equities just shining. And I got to add this one thing that I've never seen in my investment career. You had this year, this last 3 months, basically 80+% of the S&P beat their earnings estimates after 1/3 of them have been upgraded twice. In other words, the analysts are way behind what's going on in terms of earnings and gross margins. You've got a situation here where we're coming out of the pandemic with a new digital America, where a majority of these companies are selling direct to consumer at much higher margins. Nike's numbers were evidence of that. They blew them away in terms of getting more people direct to consumer at much higher margins. This is going to manifest itself in Q4 with unbelievable GDP growth, probably, maybe even double digit. So do I like stocks? Yes, I do.
All right, Kevin. Well, speaking of Nike,
hey Frank, will you let me tee up on that, because he said something about analysts being behind the curve. No, I mean tee up in a positive way. Just come back to Cleveland Cliffs for a second. All right, that stock, they've pre-announced 3 times in the last 3 months. The analysts can't keep up with it. They themselves can't keep up with it, and that's just one stock. I mean, when I talk about those 3 forces, infrastructure, supply chain onshoring, and economic expansion, that's just an incredible elixir that's going to provide free cash flow for all of the industrials and filter on through to the financials and technology. So this is a great time to be investing in the stock market.
You know, inventory onshoring, that's a narrative that we're going to have to get into when we talk about FedEx in a little bit. You would think that would help that stock as well. But before we get to that, let's get to a stock that is having a great performance today, Nike shares. They're surging to a new record high today. The stock's the best performer in the S&P 500 after the company reported a record quarterly revenue and better than expected guidance going all the way out to 2025. Kevin, I know you own Nike. I want to highlight one big part of this, their digital numbers, 41% better year over year, almost 150% better than 2019 for the same period. What do you make of that when they're also highlighting their supply chain issues?
So what's going on here with Nike, between the bull and the bears on this name, it's really intriguing because people want to see this thing trade at a 20p, and instead it's double that. But they're doing something that really no behemoth has ever done before. As you may know, they've exited Amazon completely, and they started at the beginning of the pandemic last January to start to build out their own logistics, direct shipping worldwide to their customers. They achieved in 5 months during the middle of the pandemic what they thought would take 6 years to get over 50% direct to consumer. Now, when you sell direct to consumer, you have the highest gross margins possible. Your only costs are manufacturing and shipping logistics and customer acquisition. Many people doubted Nike could actually go it on its own globally, but that's exactly what they did. They took their brand, they really spent heavily on digital advertising and really enhanced the look and feel of their products online. But here's why the market is fairly pricing this company. What we don't talk about is the analytic information they're getting from their global customer base, direct to consumer, size, style, age, purchase preferences, all that information going back to Nike headquarters so that they can use their capital to design exactly what their customers want, not just by the year, by the quarter, by the month, by the week. And they're doing it in a way that is just never been seen before. This is why you should be worried about the future of a Walmart or a Foot Locker. They don't need retail. They're direct to consumer at the highest gross margins they've ever seen. This is the new America Digital 2.0 that is not built into the earnings coming into Q4 of this year.
You know, Kevin, before I let you go, you said their only cost are some of their data acquisition and customer acquisition and shipping logistics. But those prices for shipping logistics are just going through the roof. FedEx highlighting a hard time finding people to work there. So those costs are just going to continue to go up. Do you have any concern about that when you invest in Nike with this increasing direct-to-consumer business?
compared to what? They used to get a 50 or 45% gross margin when they sold through Foot Locker or Walmart or 2 tiers of retail distribution. Now, if all they have to deal with is logistics cost and shipping direct, and their customer acquisition costs are very healthy, in other words, well below lifetime value of the customer, they've got massive amounts of margins to play with. So they can focus on this issue. I'd much rather have that problem than the one of worrying about retail, their functionality, their distribution, their warehousing, and all the margins they require. This is an incredible change. It's like a phoenix. I remember when people just hated Nike. Look at it now. It is the golden model of the new age.